Always be afraid of someone who has nothing to lose, and that includes yourself. So when you don't have a pot to piss in, then $100,000 or any sort of meaningful money seems like a long way off. But it's a lot closer than you think. And that, I think, is the turning point for investors when they start to pivot from thinking solely about appreciation to thinking about preservation as well. So if you're in 100K in tech stocks and the market goes down 50%, suddenly half your money vanishes, then you start to think more about volatility. It doesn't always go up. Now, this chart is very important because it shows the impact of when you start investing. So here's the dilemma, right? When you're young and you don't have any money, you're tempted to take a lot of risk, okay? And when you're younger, you can afford to take risks. But the sooner that you start investing, the better off you're going to be. And this is the classic example that shows Jack and Jill. And Jack invests between the ages of 25 and 35. Jill, she invests between 35 and 65, and he ends up having more money. Why? Because it's about time in the market, not timing the market. So today's presentation is really focused on the recent graduate. Now, you can invest as a student, but if you do, make sure you have no high interest debt that needs attending to, and instead you're investing. So no investing loan money. If you happen to be lucky enough to have money while you're studying, keep it safe and sane so you can focus on getting the best job possible when you graduate. Now, let's talk about a new graduate. So when you graduate from uni or trade school or whatever investment you've made in yourself so that you can make more money than just minimum wage, if you're carrying debt, usually that's student loan debt, there's debates to be had about that. Do you let that debt ride and pay minimums? Do you pay it all off? Well, the answer is probably somewhere in between. So first of all, kill any high interest debt, period. You say, what's high interest? Well, you can make 6.6% in the stock market, but that doesn't mean that any debt under that is something that you can keep around. So my opinion, the approach I take is anything with an interest rate gets killed ASAP. I don't like being other people's passive income stream. Now, if you have deferred payment or zero interest loans, go ahead and pay the minimum and you can let that stuff ride. It's free money. Now, how most people begin investing, it's usually in the time of bull markets. And if you're a recent graduate, then you've graduated into a bull market and you're probably pretty excited about investing, a lot less than you would be if it was a bear market. But as Bogle said, the more you trade, the less you earn. So it's not about trading. And what usually happens is that we've all made the same mistakes starting out. So it's likely that you're going to be attracted to the most exciting themes out there. Course correcting your behavior as quick as possible is going to determine your future wealth because, as we said before, time is the most important contributor to wealth creation. So we want to try to get those mistakes out of the way as early as possible. That's the purpose of this presentation. Many of you have asked for that critical step between having very little to getting to 100K, and that's what we're going to describe. Now, when you think about investing, you always start at the asset class allocation level. What do I mean by that? Well, asset classes are real estate, stocks, bonds, private equity, hedge funds, alternative assets. And the traditional approach taken by most advisors out there, so your bog standard Edward Jones advisor is going to say something like, all right, take your age minus 100, and that's what you ought to have in stock. So you're a 25-year-old graduate, 25 or 100 minus 25 gives you 75%. That's what you put into stocks. The 25% you put into bonds. As you age, then you see how you're allocating more into bonds. That's a very traditional asset class allocation approach. And we get a lot of questions around what you should do. Well, that's the rule of thumb, but everybody needs to make their own decisions. Here at Nanalyze, we have an asset class allocation strategy that looks like this. Quantigence on the left, that's a dividend growth portfolio, what Buffett calls equity bonds. So the problem that I have with fixed income is that it's fixed, and I don't like having a fixed income. The older I get, the less purchasing power I have because of inflation. I'd much rather have growing income streams. That's what dividend growth investing is all about. Then you see Nanalyze there. We have a disruptive tech portfolio because we love technology. It's part of our business. And you can see some European and Asian funds. These are international stock exposures that are important to have. Cash and alternatives are fun things to play around with, right? That you can make a good case for owning because they provide diversification effects. So you don't need to go down to this level. You can actually keep it very simple. We're going to talk about that. But first, when you start your first job or you're making some meaningful money, if your employer has a 401k plan, you max that out, all right? And there's a lot of varying opinions about this, but the idea is that you ought to max out any sort of plan that your employer offers, especially when they're offering free money. You always take that. And sit down and take the time and make the HR person explain to you how that stuff works immediately. Don't do this 3 or 4 years down the road like most people do. Immediately find the lowest fee funds on offer in their plan. There probably won't be any low fee funds. That's how these people make their money. Set up your allocations there. Now, this is where you might assign some traditional allocations like what they call target date funds, where it automatically scales the equities and fixed income in a fund, and they charge you for it. But today we're going to focus on take-home pay. So once that's all cleared and you've maxed out whatever free money that you're getting from your employer, and then you get that money from your employer that goes into your checking account, that's what we want to talk about. There's 3 things you need to focus on when you're building wealth. Your earning power. That's what you boosted going to uni or trade school or whatever you chose. And guess what? You need to keep pushing that up as much as possible, whether that's an advanced degree or being very aggressive in your job. Moving jobs typically grows a salary, but make sure you stay and learn something first so you have a good story to tell your next employer. And a lot of people start their first job and so there's nothing to do. You make yourself busy. You make yourself invaluable. So those skills on how to make money, that's a entirely different presentation. How to be a competent individual that generates cash for oneself. Then the cash that you're generating, when you start making a lot of money, it's very tempting to start spending like a drunken sailor. The next factor is how much you save of the money that you're making. So simple bits of advice: drive a used Toyota. You're young, in your mid-20s, get roommates, and you shouldn't be home much anyway. You should be out there busting your ass as much as possible. Take an expat position if you could ever get one. That's usually with multinational companies, especially when you're young and you're able to do that. Really push, because that's similar to this sailor approach. You know, sailors have a lot of money because they're not spending on much. They're just out at sea working all the time. So when you're an expat, you'll find that you get a lot of bonus pay for that, and that's money that you can invest. Then what you invested. Now, this is the general rule of thumb. A broad stock market ETF is going to gain 6.6% every year, inflation adjusted, okay? That's what we can expect your money to make if you just invest in the market. There's 2 roads you can take here. You can either take the road where you want to outperform the market, and there's a 5% chance or less that you can do that. Or you can say, I'm going to go down the road where there's a 95% chance I won't underperform the market. And that's simple index investing. All right. So that's the easiest way to accumulate wealth, the most predictable way. And that's what they call Bogle's 3-fund portfolio. So before we get into that, let's run the math on saving some money. So let's assume a starting salary of $50,000 a year. So that's $4,166 a month. Let's say net of that is $2,900. And then let's say you're going to save $583, so 20%. And we're going to assume a 5% salary increase a year. Now, these are all just fictional numbers. You can plug them into your own spreadsheet, and you should. And you should be forecasting, looking forward to when you're going to have your first 100K based on your circumstances. But I wanted to point to this simple spreadsheet here, which shows a salary increasing at 5% every year. Let's assume that you're doing your part to increase your salary, whether that's by negotiating for a higher salary or looking for another job if you don't get what you think you ought to be. And of course, that needs to be commensurate to the value you're adding to the organization. But you see here, I highlighted something very important. You notice how living doesn't change. You say, well, how can I live on that? Well, you're going to have to figure out how not to spend a lot of money, because guess what? Most of the people in this world don't have this much money to spend every month. So you're going to have to figure that out. And I've lived in some of the most expensive cities on this planet, on multiple continents, and I've managed to keep my living expenses very, very low by doing what the locals are doing, what the immigrants that come in, what everybody's doing to keep costs down, right? You have to get creative. Don't let your living costs rise as your salary rises, which is what you see happening here. You try to keep those fixed as much as possible. Then what happens? When you get a 5% raise, suddenly, you can see on line 2, a 5% raise becomes a 25% savings growth rate, because all of that 5% is going into your savings, right? So every time you get a raise, that's a significant boost to your savings. So your savings, the amount that you put in, is growing based on just a minimal 5% raise every year, which when you get into corporate America, you realize that's tougher to get than it sounds. But what this translates to is in 7 years, you're going to have 100K. You can see that here, right? So I've done the math. The market return simply shows 6.6% return on the money you've already saved every year. And after 7 years, you've breached the 100K mark. Now, navigating that journey, first of all, paper losses and gains come and go. So you don't pay much attention to that. Focus on investing every month using dollar cost averaging, right? So you're not going to try to lump sum it. You're going to take money that you get from every paycheck and invest in the market. You're going to learn the most from your mistakes. So model everything in Excel so you understand where every penny is going and the mechanics of your investments. Most importantly, your standard of living doesn't need to match your salary. You say, now what? I have 100K. At a 3% yield, that's $250 a month in passive income that you didn't have before. So when you hit that mark, you can certainly reward yourself with a small cost of living increase. But what you ought to then continue doing is reinvesting whatever yield you're getting off of that money right back into the same funds that you have been investing in. And we've assumed market performance that anyone can achieve, that 6.6%. That's just by investing in index funds. What about trying to beat the market? So this is where everybody starts asking more questions, right? They want something more interesting. Well, 95% of people can't beat a benchmark over the long term. We did a recent piece titled "He Lied," with a picture of Warren Buffett, talking about this fact. So having a strategy is going to be your only hope. That's a documented strategy. We have our own here at Nanalyze. We've developed over decades. You need to have that strategy and utilize it with conviction. And then you can enjoy the best of both worlds. So what we call here a modified Bogle strategy. Now, the principles of Bogle here: live below your means. This is things we just talked about. This is right from their website. There's a lot of Bogle heads out there, what they call people that follow Bogle's beliefs. And they're all listed out right here. And every single one of these things you ought to adhere to. And the basic tenets of this strategy are a 3-fund portfolio. You see, you stick to one family, whether that's BlackRock or Schwab or State Street, Vanguard, right, low cost. And you invest a certain percentage in each one of these. Keep it easy, 30% each. And remember we said 100 minus your age, so maybe the bond one, you reduce that down and then you increase that as you get older. There's no wrong answer here. We get a lot of questions about, what percentages are right. Whatever you think you ought to do, just put it 30, 30, 30 and leave it at that. There's no wrong answer. What you can then do is you can substitute one of those portfolios then and put in your own portfolio. So if you're not into fixed income, for example, you can just substitute that out and have your own managed portfolio. First of all, don't go looking for ideas. Everybody does that. They want ideas. Start from the top down, okay? What are you trying to substitute that for? So we looked at those 3 previous portfolios. You have total stock ETF, that's United States. You have total international stocks, that's U.S. stocks, and total bonds. So what? U.S. stocks, international stocks, bonds. You're going to substitute one out, or maybe you make those 25, 25, 25, and then 25% goes into your own managed portfolio. What are you looking for? Well, you're young, you can afford to take more risk. Perhaps you want to overweight growth stocks. It's a reasonable notion, right? Everybody's all excited about technology and bull markets. Well, Very easy to do with an ETF, but maybe you want to be challenged. So maybe you have 4 portfolios, and one of those then becomes your own managed portfolio. So ideally, you ought to have at least 10 stocks, all right? And use equal weighting to keep things simple, so each one is 10%. We like to have, as most portfolio managers do, a cutoff that says if a certain stock in my portfolio hits, let's say, 30% of the total portfolio value, then I'll trim it, right? So this goes to the point of having an exit strategy for every stock you buy. Broad rules are sufficient. Have a theme. So in our we have 2 portfolios, Disruptive Tech and Dividend Growth. Those are the themes, or you can have a combo, right? Use fractional share ownership, which most brokerage firms offer, which means the price of a share doesn't matter. You're going to purchase an equal amount of money in every single share every single month. Go for equal weightings and adjust your contributions based on that. So if you get a runner in your portfolio, you can simply stop allocating if you like and allocate to the others to bring those weightings back up. That's one way that you can also account for valuations as well. Pick a day of the month that you invest. Don't ape other people. And make sure that once you have your portfolio put together, you describe each position using factors. So growth versus value, size. Are you overweighting on size? Certainly they'll all be U.S. stocks likely. So then that's an overweight. Sector, are they all in tech? Most people's portfolios are. So be careful about that. Understand the exposures that you have. But don't ape what the lemmings on social media are doing. Everybody has this passing around the same tickers. That goes back to this point about not looking for stocks, right? Start from the top down. Think about what you want, and then end up with asset class allocations that match your tolerance for risk. So talk valuation real quick. We use simple valuation ratio for tech stocks. That's market cap divided by annualized revenues. We'll take a historic average and purchase below that watermark with a cutoff. So this example here shows Palantir and NVIDIA both quite stoked on AI hype, and you can see that cutoff somewhere there around 19 we wouldn't purchase any stock above that cutoff, and then you just wait for these stocks to dip back down, revert to the mean as they always do. For ETFs, you just purchase at regular intervals. It's really simple. In a dividend growth portfolio, you can rebalance based on weightings. That's what we do. It works quite well and takes into account stocks that are perhaps overvalued versus undervalued. In tech investing, you better be comfortable with large paper losses. And if you're buying over the next decade, you want the market to be crashing. Market going up is not a good thing, but you're happy either way, right? If it goes up, you're happy because you see your assets going up. If it goes down, you're happy because you're purchasing cheap assets. So some parting thoughts. We get a lot of people asking for permission or approval, and again, there's no wrong answer. So just the basics that I've described today. If you're taking the Bogle approach, the 3-fund approach, you just can't go wrong with that, seriously. Now, asset class allocation percentages, 100 minus your age, whatever, these were created for growth versus income. They're really subject to whatever tolerance for risk that you have. So when we look at income, we use Buffett's notion of equity bonds for our income component, so we don't invest in fixed income. Just remember, whatever portfolio you have, it's like a bar of soap. The more you handle it, the smaller it gets. And of course, everyone has a plan until they get hit in the face, and sleeping well at night is underrated. So if you're managing your risk and you're properly diversified, then you're not going to be blindsided by anything, and you'll sleep very well at night. So I put up another presentation here that you might like. It's on Bogle's 3-fund strategy. It talks about Bogleheads, and their approach to investing is quite good. Please make sure to subscribe to this channel. Thanks so much for taking the time to watch this today.